Hello and welcome to the Crypto Beat. My name is Tim Copeland. I'm the head of growth at The Block. Joining me today we have Securitize President Michael Sonnenshein and my new now permanent co-host Kelvin Sparks. Welcome to the show. How are we both doing?
Great,
Good.
great to be here. Thanks for having me.
Yeah. Doing
Cool.
good.
Before we get started, just a quick note: if you are hiring in crypto, we have a platform called Campus. Use a crypto knowledge test to find out your best candidates and pick out the real crypto natives. Head to theblock.co/campus to get a 3-month free trial. Now, today's episode is about tokenized equities, and there's no company better than Securitize to sort of break down that topic. So, Michael, recently you were, I guess, focusing on you a little bit first. You were promoted from COO to president of Securitize, and as part of a recent trend of presidents, we now have the Block CEO became president, Larry Cermak, the Ethereum Foundation president. It's definitely you're trending. So, what was the reason behind the move?
Really just to have the opportunity to focus even more so on our core business at Securitize. There's no question that as the business has grown over the last 7 or 8 years, with more business lines and spreading out into more geographies, there's been an opportunity to kind of reestablish leadership across some of our different business lines, better organize ourselves as we really can kind of continue want to scale the company up from here. So that's really kind of the motivation behind the move.
Cool. And then a topical question. The White House recently released its digital asset report, I believe yesterday, if it wasn't the day before. What did you make of it?
Well, listen, as somebody who's been working in the crypto space now for over a decade, and have really been through many different cycles of seeing regulatory clarity, accommodative approaches to the space, restrictive approaches to the space, there is no question right now that this is one of, if not the most exciting industry in the world to be a part of. And it has been nothing short of incredibly invigorating and exciting to see tailwinds where we have our government actually coming out and saying that they want the US to be the hub of crypto innovation. They want the US to dominate and exert its influence over the crypto ecosystem. And rather than just making it in the form of statements, we're actually seeing concrete, text that's actually being shared publicly. And so it almost feels like a real 180, if you will, of where we were from even just a few months ago here in the United States. So the report I think was, 40 some odd pages long. So I can't say I've gotten through every single piece of it, but it is certainly encouraging to see some of the call outs from the White House report, really encouraging our regulators to take action, revisit everything from how transfer agents are able to custody or leverage digital asset technologies and blockchains, re-examining things like Reg NMS, which looks at, equity securities here in the United States, trading on public markets. It looks at creating safe harbors or certain types of relief for crypto market participants to begin to engage in new innovative business models. And so, again, this report's, I don't even think 12 hours old. But I think as we as an organization and our other counterparts across the industry digest this definitely gives us an even further call to action to continue to educate our regulators, educate our legislators, and make sure that the US does continue to develop frameworks to have these types of businesses flourish in the US and for US investors.
And how would you say like regulators have changed in terms of their willingness to go into the details on security tokens? Because they're struggling to get their head around just regular tokens, let alone ones that are also trying to fit in with the current rules. Like, are they a lot more open-minded? Are they really trying to understand? And are they going to put forward some actual sensible laws and regulations?
Well, I think that's actually really core to what we do at Securitize. So, the tokenization space is quite large. Within that, we solely focus on tokenized securities. So the assets that we're bringing on chain are assets that are ideated, launched, sold, trade, owned, et cetera, all as securities, right? We're not trying to cause the asset to mutate into some other form or skirt some kind of securities rule or regulation, but instead we're actually ensuring that the assets themselves remain truly securities, just residing on better technology, better rails, which is what we're so excited about. And so you've seen even just recently over the last couple of weeks, commentary from SEC Commissioner Peirce talking about the role of tokenized securities, ensuring that, as businesses like ours are bringing these assets onto public blockchains, that we're ensuring proper disclosures are being made, we're ensuring that investor rights and protections are being held up. And so these are types of statements, the types of guidance and kind of interaction that I think we as an industry and certainly we as a company at Securitize have never, seen before. This is unprecedented. And so I do believe that our regulators are taking a much more front-footed approach. But again, I don't think we're trying to completely upend the system, but instead leverage technology and leverage the strength of like the proliferation of this asset class to really ensure that we're upgrading it in a way that's responsible for investors.
Okay, when it comes to like tokenized equities, what's the sort of broad vision there? Like, how do you imagine that playing out over the next few years?
Well, I think we have to talk about that in the context of kind of what the on-chain investor is looking for today, right? In general, you see that on-chain investors have historically and today are continuing to, invest in and speculate on digital assets, things like Bitcoin, Ethereum, Solana, et cetera. And as these pools of capital, as these pools of wealth have gotten larger, they're looking for diversification and they're looking to keep that value that's been created on crypto rails. And that often is coming in the form of, what they believe to be safe, top tier asset issued securities, and often securities that are providing them cash flow. That's why you've seen such strong adoption for things like tokenized treasuries and tokenized private credit, which hopefully we'll have some time to talk about. But as you're starting to see more and more investors getting comfortable, not just owning digital assets in their wallet, but now beginning to own more traditional investments in their wallet, there's a real call to action to kind of merge what they would typically access in a brokerage account inside of their wallet infrastructure, inside of their, crypto infrastructure. And so for a lot of companies, for a lot of investors, moving into tokenized equities is the next big frontier. These are highly liquid assets. These are assets that investors already own, but they kind of want to combine those two pools of capital. And so when you look broadly at the tokenized equity space, there's generally two approaches that companies are taking to it. The first approach really involves companies creating special purpose vehicles or wrappers where an investor owns a tokenized interest in that SPV or that wrapper that then owns the underlying then owns the underlying equity. We think that this is certainly innovative, but we actually think it reveals quite, fervently some vulnerabilities, right? The investor has counterparty risk that SPV or that wrapper. The investor doesn't kind of enjoy the same rights or obligations as they do when they own the security directly, because again, they're owning an interest in a wrapper or special purpose vehicle. At Securitize, we've taken kind of the second approach, which we feel really does confer all the rights and ownership of investors when they are moving on chain. And that's to natively bring tokenized equities on chain. So far, we've done this for a nicely listed company called Exodus, where you can actually take shares of Exodus that you buy in your brokerage account, put them back to us as transfer agent, and we'll actually deliver back to you to your wallet tokenized shares of Exodus. And so functionally, as an investor, you actually own the exact same security, same rights, same obligations, same ownership. And here, the actual issuer, the actual companies involved in that process, as opposed to in the wrapper format, the issuers often aren't involved. And so as we're starting to see this play out in the industry, we definitely have some concerns around multiple versions of tokenized securities that won't be composable, that'll have different liquidity profiles, may not have the right disclosures, and certainly won't have the right, or similar pricing. So there are some concerns about how that's going to shake out, but it's still kind of the beginning of that evolution.
So actually, one of the things that I was curious about earlier into your last comment was around tokenized treasuries as well as tokenized credit. Why is there so much demand within these two specific sectors of tokenization?
Yeah, I mean, I think there's this general belief that almost anything can or anything should be tokenized. And I don't necessarily think that that's the case today or may necessarily be the case in the future. I think instead, what investors are looking for today are highly liquid and yield generating investments. And so treasuries on traditional rails are pretty much what makes the world go round. Treasuries are what folks are using to collateralize their trades. Are how different counterparties are getting comfortable with transacting with one another, and so it's only natural for us to kind of move away from solely leveraging stable coins, which have kind of been that common denominator across the crypto ecosystem for many years, to now being able to use tokenized treasuries that again are these really high quality super liquid assets that actually share in the yield that's generated from them back with investors, whereas stablecoins more often than not do not. And I think as investors have gotten increasingly comfortable with tokenized treasuries, they've also then been comfortable moving a little bit further out on this risk spectrum, but also still with relatively liquid assets into things like private credit, where for a little bit more risk, they can get a little bit more return, a little bit more yield.
Yeah, thank you for that. And another thing that I was curious about, previously you spoke at Securitize about the path to 1 trillion in tokenized securities. Obviously, it's a
Yeah.
bit of speculation at this point in time, but what does that look like? And is there any path dependency involved in that journey to 1, 2?
Yeah, I think for a lot of the growth that we're seeing, I mean, if you even just look at the RWA market in the last 6 months, it's grown about 60%, right? It's now about $25 billion, and it's probably about 15, $16 billion at the start of this year. So it's growing very rapidly. I think in order to continue to grow on this path or see growth accelerate, there needs to be a really intense focus on kind of the user experience and what those access points are. So what I do see playing out in the market now is almost a fight, if you will, for market share, or wallet share rather, and no pun intended there, right? Where if you are providing investment offerings, investment services, you're seeing traditional firms, brokerage firms begin to offer things like spot crypto trading and things of that nature, but maybe not necessarily have the infrastructure or yet comfortable with offering tokenized investments. On the other hand, if you're coming from the crypto ecosystem, that's why you're seeing them look to steal market share from so many of the traditional players to offer things like equities, to offer things like tokenized treasuries, tokenized private credit. And so ultimately, I do see a merging of these worlds. And if we can make the user experience seamless and we can answer the call that I think users want, which is 24/7 liquidity, the ability to transact peer to peer, the ability to have these investments interact with the world of DeFi in a way that's compliant and that makes them comfortable, I only see growth ahead for this industry. It's a very exciting time to be thinking about tokenization and specifically the tokenization of securities.
You mentioned a couple of different ways to do tokenized securities. What did you think of Robinhood's tokenized equities, and which strategy are they taking?
Yeah, so there's a lot of different models that are going here, and to be clear, even models like Robinhood and others, to best of my knowledge, haven't yet been launched, right? So these are pretty much at this point mostly announcements. A lot of these announcements are actually focusing on jurisdictions outside of the United States, really helping to offer investors in other jurisdictions to access US listed securities. And so some folks like Robinhood are hoping to launch, their own chain where these assets can trade and where these assets can settle. But ultimately, again, what we think is so paramount, and certainly what the SEC has really shared with us, both in the form of these public comments that they've shared, as well as how they've been interacting with the industry, is that it is really important that as we bring these investments into an on-chain environment, that we are not skirting existing securities laws, right? There's very tried and true ways in which assets are raised, assets are sold to US based investors, and simply because we're going to bring these assets onto a new technology, onto a new ledger system, does not mean that we can, skirt those existing rules or laws. And that's why we think this, kind of direct native tokenization model versus a wrapped model is really important to closely examine.
Okay, what are the biggest risks for using sort of wrap models?
Yeah, I think the biggest risk is really the counterparty that you're buying from, right? Ultimately, if you're buying a wrapped version of a security, you're relying on the good faith and kind of credit, if you will, of the issuer of that asset. The same goes for any rights or obligations you have as an underlying as a tokenized shareholder, whether or not anything from voting rights or dividends or corporate actions or any of those other issues are brought to you as an investor in the wrapper that sits atop that security. And then also disclosure and pricing, right? I think unfortunately we could end up in a situation where you have multiple versions of the same underlying security that are tokenized sitting in many different ecosystems that have very, very disparate pricing. And that does not necessarily act in a way that protects investors or protects their pricing or executions. And, I think that's ultimately problematic for investors if they are really looking to get exposure in a fair and transparent way.
Okay, and can you explain to me like the benefits of tokenized equities in this way? Because for instance, I'm assuming if I'm buying one of these tokenized equities from Securitize, I'm like going through KYC, I'm in a regulated platform, and then I'm, compared to if you're buying equities, same sort of story. Yes, you mentioned like market hours, but then there's also pre-market trading. Like, what are the main benefits?
Yeah, I think for a lot of folks, it's about consolidating their pool of capital. And also, beyond just even equities, what we're seeing certainly in the form of tokenized treasuries is the ability to unlock features and attributes in these funds that are just not able to be accomplished on traditional rails. So when you look at, for instance, our product with BlackRock, BIDL, tokenized treasury fund, the largest tokenized treasury fund, dividends are paid out to investors on a daily basis. So they actually have that access to capital and the ability to compound that capital immediately. Whereas owning things like treasuries directly or money market funds, you only get access to that monthly or maybe even quarterly. I think for us at Securitize, we're also very focused on the utility of these investments. So we want investments to be made useful. Let's face it, buying assets in tokenized form today may not be as easy or as frictionless as it is to buy these on traditional rails. So if we are going to have investors going through the additional, KYC, AML, providing us with wallets, whitelisting those wallets, we have to ensure that on the other side of that experience, that investors are able to unlock some additional utility. Otherwise, why are they doing this? And so whether it's more frequent access to capital, if it's the ability to take these assets and connect them to the world of DeFi so that they can undertake other activities that may include leverage or looping. These are the types of initiatives that we're seeing investors wanting to undertake. And those opportunities just aren't available when they make similar investments on more traditional pathways.
So one of the things I was actually curious about, you kind of brought up via the leverage and looping aspect that you may not be able to get via the analog assets. Are you seeing real demand for this currently? And if so, what's the anticipated growth look like?
Yeah, so we definitely are seeing it. I think what's been so exciting about working in and around tokenized securities is that they're actually taking on entirely new identities in tokenized format versus their traditional counterparts. So when you think about a money market fund, for example, on traditional rails, most of us think about a money market fund as a safe place to park capital, earn some yield. It's generally, liquid, but, it has confines. You need to buy it and sell it by a certain, order cutoff time each day. There's certain days perhaps when the fund may not be open, et cetera. And on the contrary, when you think about these types of assets in tokenized format, they have atomic liquidity. You can, buy and sell them 24/7. They don't care about market hours. They don't care about, necessarily, holidays and things like that often their traditional counterparts do. And not only that, but then the ability to be able to borrow against these assets, to borrow stable coins against these assets in the world of DeFi, that really allows folks to start engaging in, looping strategies that can actually take these core, high quality, top tier asset issued assets and then begin to lever them up to increase their returns. And so we're certainly seeing that in places like private credit with Apollo and the Apollo diversified credit fund that we offer. And then we're also starting to see that in places like Scope, which is the product that we run with Hamilton Lane, their senior secured loans product, as well as, even across things like tokenized treasury funds, like on BlackRock's Biddle product. So this is the types of activities, and generally speaking, the risk tolerance and the type of leverage that the on-chain investor is looking for, and they're not able to use these types of assets on traditional rails to achieve those same types of return profiles.
Cool. And talking of Hamilton Lane, just now a proposal has gone live regarding integration with Elixir. Can you tell me about that and what it means?
Yeah, so the product that we have with Hamilton Lane Scope is a product we've had for some time, and that product recently went through some upgrades. The product expanded from Polygon as well as onto Ethereum and Optimism, and that's working closely with our interoperability partner, Wormhole. And recently, or I think it was this morning, a proposal went out to upgrade this product so that a percentage of the fund's assets would have atomic liquidity in partnership with Elixir, so that investors wanting to instantly mint or instantly redeem the product would have the ability to do so. Again, showing real utility for these assets in an on-chain environment versus their traditional counterparts, which may only offer liquidity with a certain amount of advance notice and potentially holdbacks before an investor is fully able to redeem a position. So it's exciting to see partnership and participation from other crypto market participants to be able to add these types of features and unlock that additional utility for investors.
Okay, can you explain more specifically what's happening with Elixir?
Yeah, so I think the specific proposal is to have 5% of the fund's assets held in DUSD, Elixir's stable asset. And so with that pool of liquidity, it offers greater ability for investors who want to atomically redeem or atomically subscribe to the fund, a pool of capital that can be tapped in order to facilitate those types of transactions. Again, something that we view as really unique, and something that certainly sets this type of product and the ability for investors to interact with it in this manner definitely different from its traditional counterpart.
Okay, cool. And then obviously you're very well known for being at Grayscale for a very long time.
Yeah.
So a little throwback to when you turned GBDC, which was the biggest Bitcoin fund back then, into an ETF. Looking back at that, did you think the ETFs would do as well as they have done?
Oh, there's no question about it. I mean, I look back very fondly on my time at Grayscale and the team and the work that we did. It was nothing short of invigorating and exciting, but equally, if not more challenging to think about, suing the SEC at the time to gain approval for Bitcoin ETFs on behalf of, hundreds of thousands, if not millions of investors. Um, and you can go back and look at some of my old interviews. It was always a matter of when, not a matter of if that would come. And I think, given where we are in the life cycle of digital assets, sure, it's becoming easier and easier for folks to access crypto directly. They're getting more comfortable accessing crypto directly, but there's just so much capital that is still on traditional rails looking to allocate to new investments and new return streams. And the ETF wrapper has just been such a fantastic way for folks to gain exposure, gain access to unique assets, that bringing a innovative asset like Bitcoin into that wrapper and basically into the fabric of our financial system, was certainly going to be met with a lot of success. So I think those assets still have a lot of room to continue to grow. And I think even now, thinking about this new SEC, this new administration, I think you're also going to see the proliferation of other digital asset ETFs in the market as well.
Okay, and what did you make of the SEC approving in-kind redemptions to the ETFs?
Yeah, I think it's long overdue. When Bitcoin ETFs were originally approved, it was restricted to only being able to have market participants, authorized participants, facilitate creation and redemptions of the ETFs using cash, which was really viewed as a departure by certainly my team as well as the ETF industry as a whole, because typically for commodity-based products, the in-kind creation redemption process was a pretty tried and true path. So it was certainly felt, I think, like a wrongdoing that had been righted by bringing back around that approval. And I think again will hopefully make these products trade even more efficiently for investors interacting with them.
So I actually think this is a bit tangential to that, but with the approval of in-kind redemptions, and I'd say maybe we'll say the technological aversion to the average person, do you think this actually changed the self-custody conversation? I mean, you have brokerage houses like Fidelity allowing access to these highly liquid products, and the average person doesn't even really need to think about where they would store their seed phrase or how to make sure that they don't lose access to this thing.
Yeah, I mean, I think it's an important topic. I think it really depends on, how different brokerage firms or different platforms treat these assets. Something like an ETF, may receive a certain loan to value, and so getting leverage on it in the form of a security may be very different than the way some of these brokerage firms treat, leverage or assigning a loan to value to a spot commodity. So I think that'll differ between the different platforms, but ultimately there will continue to be a strong use case and a desire on behalf of users to both access these assets directly as well as access them in the form of a security.
Understood. And I guess where do you think the ETFs are headed from here? Just more growth? Or?
Yeah, I mean, I certainly think you've seen some recent commentary from the SEC talking about new listing standards around spot commodity ETFs, spot crypto ETFs, and so I do think you'll see more spot crypto products coming to market. I think there's also been a lot of demand for a diversified basket of digital asset ETFs coming to market, and I think investors want kind of that singular investment opportunity that gives them that broad-based exposure. So some of those types of permutations are certainly overdue, and I think there's strong demand for them as well.
Okay, now moving on to treasury companies like Strategy, are you concerned at all by the potential systemic risk of these Bitcoin treasury companies?
Well, I'm not as close to the treasury companies as others might be because we're certainly not a treasury company ourselves. But there has certainly been no shortage of announcements of new treasury businesses as well as some very smart investors looking at how to properly manage these treasury companies, whether they're for Bitcoin, for Ethereum, or other digital assets. It'll be interesting to see how that part of the ecosystem continues to play out. Some of these are, I think, morphing more so into operational businesses rather than just strictly or passively holding these assets. Some of them are actually taking a much more front-footed approach to engaging with the ecosystem for the underlying digital asset and trying to find ways to return yield or generate income for their underlying shareholders. But this is really more of a kind of a recent subset of the crypto universe that I think has really only recently come online as part of this most recent cycle.
Yeah. Do you think there are any parallels with GBDC? Because with that, you had a lot of capital flood into that as people were trying to make money off the premium, but then ultimately struggle to get out of it. Whereas with the treasury companies, a lot of money is flowing in as people are looking for this yield, but then it might be also hard to cash out sort of that amount of Bitcoin and get out of that play. Like, do you think there's any similarities?
I think it depends. I think, one thing that again, it's too early to say as these companies are really in their earliest days of their formation and their strategies around capital allocation. But as I look at them and the premiums at which some of these businesses may be trading to their underlying NAVs, as those types of valuations move around, they also have the ability to also buy back stock, which I think is, a very different scenario than looking at, something like a GBTC or looking at an ETF. So over time, hopefully we all believe markets are efficient and these assets will find their footing. But again, early days.
Cool. Well, thanks for that. That's all we have time for today. I want to thank Michael for joining this episode and Kelvin for being my new co-host. As a reminder, our newsroom works tirelessly to get you accurate, informed crypto news. If you want to stay ahead, read the blog. Thanks, and see you next time.
Thank you.
Thank you.